China holds roughly 3.2 trillion in U.S. dollar-denominated assets, Treasury bonds, corporate bonds, currency reserves, mortgage-backed securities. No other nation on Earth is as exposed to the American financial system. Not Japan, not the United Kingdom, not even the entire European Union combined. And for years, analysts, politicians, and the financial media have repeated the same ominous warning. What happens if China dumps it all? What if Beijing decides to weaponize its treasury portfolio and unleash a tidal wave of sell orders? According to this narrative, the dollar would collapse, interest rates would skyrocket, Washington would face an unmanageable funding crisis, and American economic dominance would evaporate overnight. It has been described as China's nuclear option, the financial weapon of mass destruction, supposedly sitting in Beijing's back pocket. The part almost nobody explains is the paradox. China cannot use this weapon, not because it chooses restraint, not because it fears retaliation, but because the moment it pulls the trigger, it detonates its own economy. This is not a sword pointed at America's throat. It is a trap, one that has quietly ensnared both superpowers. The United States and China are locked inside the most complex financial hostage situation in modern history. Both are holding a gun to the other's head, fully aware that firing would cause mutual ruin. The most alarming part is not the hypothetical scenario of a sudden liquidation. It is the slow, steady reality unfolding right now. China understands the trap better than anyone, and for more than 15 years, it has been trying to engineer an escape accumulating gold, developing alternative payment systems, reducing treasury exposure, and attempting to insulate its economy from dollar dependence. The challenge is that the trap sits at the core of China's economic model. Untangling it takes decades, and the real uncertainty is whether the system unwinds gradually or collapses before China finds the exit. To understand why the situation is so inescapable, you have to start with the assets themselves. As of mid-2020, China holds around $7 billion in U.S. Treasury securities, the lowest level since early 2009. Beijing has been actively trimming these holdings, and recent monthly reductions have been the sharpest in years. This drop even pushed China from second to third place among foreign holders of CIS debt. Japan still holds more than $1 trillion worth. The United Kingdom holds close behind. But this narrow view misses the deeper story. Treasuries are only one piece. China also owns enormous volumes of U.S. corporate bonds issued by tech companies, banks, industrial giants, estimated between $300 billion and $100 billion. On top of that, it holds $500 billion to $700 billion in straight U.S. dollar reserves, uninvested cash, stored for stability. And then there are the mortgage-backed securities, Fannie Mae, Freddie Mac, the same instruments at the center of the 2008 meltdown. China purchased hundreds of billions of these when they were undervalued. Current estimates place these holdings near $200 billion. Add equity exposure U.S. stocks purchased indirectly through sovereign wealth funds and state-linked institutions, and Chinese entities are exposed to another $1 trillion to $1 trillion in American markets. Put it all together. Treasuries, corporate bonds, currency reserves, mortgage securities, equities, and China's total dollar exposure land somewhere between $2.8 trillion and $3 trillion, with $3 trillion being the accepted midpoint. And the key insight is this: These are not just financial assets. They are the structural backbone of China's entire growth model. China built its modern prosperity through 4 decades of massive trade surpluses. Factories shipped everything from electronics to machinery to textiles around the world, and in return, they received dollars. Exporters exchanged those dollars for yuan at Chinese banks, and the banks funneled them to the central bank. The People's Bank of China could not simply sit on mountains of cash. It had to invest them in something liquid, something safe, something capable of absorbing hundreds of billions per year. Woo. Treasury bonds were the obvious answer, and there was another strategic purpose. Buying treasuries kept the yuan artificially weak. Each purchase required selling yuan and buying dollars, suppressing China's currency value. A weaker yuan meant cheaper exports, more competitive pricing, larger trade surpluses, and more dollars flowing back into the system. It was a feedback loop, a beautifully efficient, self-reinforcing engine of growth. The dollar reserves were not a side effect of the model. They were the model. This is the first layer of the trap. China cannot unwind its dollar exposure without undermining the economic machine that created its rise. But the second layer is far more dangerous. The fantasy scenario often portrayed as a looming threat. China deciding to dump all $3.2 trillion at once. If Beijing ordered its traders to liquidate everything, the U-Boss, Sitge's Treasury market, the deepest, most liquid bond market in the world, would experience an unprecedented shock. Prices would plunge. Yields would surge. A 10-year Treasury currently yielding around 4% could suddenly shoot to 8% or even 10%. That single spike would freeze the American housing market almost instantly. Mortgage rates would climb into the teens. Home prices would fall sharply. Consumer spending, which relies heavily on housing wealth, would contract. Corporate refinancing would become prohibitively expensive. Bank balance sheets would implode as the value of their treasury holdings collapsed. The Federal Reserve would be forced into emergency intervention, absorbing the dumped bonds and printing vast sums of money to stabilize the market setting off another inflationary spiral. The cascading consequences would affect every corner of the U.S. economy. A surge in import prices, currency devaluation, deep recession, and severe financial instability. On paper, it looks catastrophic. A direct strike at America's financial heart. And yet China suffers even more. Dumping treasuries would destroy the value of its own reserves. The dollar would tank. Assets held in dollars would plunge. China's banking system, already stressed by debt, bad loans, and property sector turmoil, would face enormous losses. The yuan would spike uncontrollably, devastating China's export sector. Millions of factory jobs could vanish. Foreign investment would flee. The very foundation of China's economic model would collapse. Beijing would gain nothing except chaos. This is the immutable logic of the dollar trap. Any attempt to weaponize it triggers mutual economic destruction. And because both nations know this, neither can escape quickly. China is trying to diversify, slowly reducing treasury exposure, buying gold, promoting the yuan in trade agreements, experimenting with digital currency infrastructure, and building alternative systems. The United States, meanwhile, is increasingly aware that its financial dominance depends on a delicate balance, one where China remains deeply invested, yet unable to disengage. The real danger is not the dramatic scenario of China selling everything. It is the slow erosion of confidence as both nations maneuver within a system they can no longer fully control. The dollar trap is not a static structure. It is a slow-moving fault line beneath the global economy. The question is not whether tensions will rise. They already are. But whether the system can unwind without triggering the very collapse both sides are desperately trying to avoid. When you see interest rates surge, the immediate consequence is that federal borrowing costs explode. The USA government already pays roughly $1 trillion per year just to service the national debt. If Treasury yields suddenly double, that annual interest bill jumps toward $2 trillion, an amount larger than the entire defense budget, larger than Medicare, and comparable to a substantial portion of Social Security. The government would be forced into impossible choices, spending across politically sacred programs, or print vast sums of new money to cover the gap. Either option, accelerating the crisis rather than containing it. This is the nightmare scenario often described as the financial nuclear option. China presses the button, and the American economy buckles. But the reality is brutally different. The moment China begins dumping its Treasury holdings, it triggers a chain of events that hits China even harder than it hits the United States. The first shock comes through the foreign exchange markets. If China unloads hundreds of billions of treasuries and simultaneously sells down its dollar reserves, global traders panic. The dollar's exchange value collapses. Suppose the dollar drops 30% within weeks. That would be disastrous for the U.S., but it is catastrophic for China, because treasuries are only a fraction of China's exposure. Beijing still holds roughly $2 trillion other dollar-denominated assets. Corporate bonds, mortgage securities, currency reserves, equity stakes. A 30% decline in the dollar wipes out 30% of those holdings. That is a $750 billion loss. Loss erased almost instantly. The People's Bank of China, which relies on its reserve portfolio to give credibility to the yuan, would suffer a massive balance sheet shock. With total foreign exchange reserves around $334 trillion, losing $750 billion is not an inconvenience. It is a hit equivalent to 22% of the entire reserve base, a scale large enough to raise questions about solvency, confidence, and stability. Market psychology matters as much as numbers. When investors perceive the central bank of the world's second-largest economy as weakened, they pull back, adding additional pressure. And the damage cascades far beyond the central bank's books. China's growth engine relies heavily on exports, which comprise about 20% of its GDP. The United States, China's single largest customer, buys approximately $500 billion worth of Chinese goods annually. When the dollar collapses and the yuan's economy enters crisis, American consumers abruptly reduce spending. Chinese factories that operate on narrow margins suddenly have no orders, no cash flow, and no way to sustain payrolls. Unemployment spikes in export-dependent regions. Then comes the currency shock. If the dollar falls by 30%, the yuan appreciates automatically by approximately 40 in relative terms. That means Chinese goods become 43% more expensive for American buyers overnight. Even if Americans wanted to keep buying Chinese goods, suddenly they can't afford them. This is the exact opposite of what China has engineered for decades. Beijing has always kept the yuan artificially weak to fuel exports. A sudden involuntary strengthening of the yuan is the economic equivalent of slamming the brakes on a speeding freight train. But the deeper, more insidious damage surfaces inside China's financial system. Many Chinese banks and corporations borrow dollars on international markets because dollar loans are cheaper than yuan loans. Many Chinese firms issue dollar-denominated bonds to global investors. When the dollar collapses, the value of their obligations, measured relative to their yuan revenues, suddenly skyrockets. If the yuan appreciates by 40, every dollar owed becomes 40 more expensive to repay. China's corporate sector carries about $28 trillion in debt, with roughly $3 trillion of that denominated in dollars. A 40 currency move increases their real debt burden by more than $1 trillion. Few firms can absorb that. Defaults ripple through the corporate sector. Banks holding those loans or bonds take heavy losses. The Chinese financial system, already strained by property sector weakness, faces a systemic crisis. In theory, Beijing could bail out the banks. In practice, this is nearly impossible. The government has just absorbed a $750 billion loss on its dollar reserves. To rescue the banks, it must print yuan on a massive scale. That means monetary expansion, which ignites inflation. China has spent decades keeping inflation under tight control as a core pillar of social stability. But if prices start rising rapidly, especially in essential goods, ordinary citizens feel immediate pain. The majority of Chinese household wealth is stored in real estate and yuan-denominated savings. Inflation erodes both. Confidence cracks. Social unrest becomes a real possibility. And then comes the final blow. Energy. China imports roughly 70–80% of its oil and massive quantities of natural gas and coal. Virtually all global energy contracts are priced in dollars. Even if the dollar collapses relative to other currencies, China must still pay whatever the global market demands in dollar terms. That means China must spend more yuan for the same amount of energy precisely at the moment when inflation is already rising, when corporate defaults are climbing, when banks are under stress, and when the export machine is choking from a lack of demand. Energy costs double. Manufacturing margins vanish. Factories operating on tight spreads simply shut down. Add it all together, China sells off its Treasury holdings. In the process, it destroys the value of the remaining $2 trillion in dollar assets. Its export-driven economy slams into a wall as American demand collapses and the yuan surges. The corporate sector suffers a massive debt crisis due to currency mismatch. Banks fail. The government prints money to rescue them, igniting inflation. Energy costs soar, manufacturing stalls. Social unrest brews. The entire Chinese economy spirals downward, and it happens faster than the damage inflicted on the United States. The Wuxia possesses advantages that China simply does not. The world's deepest capital markets, the world's most trusted currency, a diversified economy, and a central bank capable of injecting liquidity instantly. The Federal Reserve can print dollars at will, and global markets accept those dollars. China's central bank cannot print global trust. The yuan is not a reserve currency. It is not widely held in foreign central banks. Capital controls prevent free movement of money. And global investors cannot easily hedge risks in China because its markets remain partly closed and heavily state-managed. This is why the $3.2 trillion is not a weapon. It is a trap. It is a hostage situation in which China is holding itself hostage. The so-called nuclear option is a gun-pointed issue. Beijing knows it. Washington knows it. Investors know it. So if China can't escape through confrontation, what is it doing? It is building a slow, deliberate, Generational strategy to unwind the dollar trap. The approach rests on three pillars. First, gold accumulation, quietly increasing reserves to reduce reliance on dollar-backed assets. Second, alternative payment systems. Beijing has spent years constructing financial infrastructure that can operate outside the dollar-dominated networks. The Cross-Border Interbank Payment System, or CAPS, launched in 2020, is China's attempt to build a settlement network denominated in yuan, rather than dollars. It processes trillions annually, still small relative to the global benchmark, swift but expanding rapidly. China has also negotiated dozens of bilateral currency swap lines to settle trade directly in yuan, bypassing the dollar entirely. These deals, now worth hundreds of billions, form the early architecture of a yuan-centric trading bloc. The long-term vision is clear. Create an ecosystem where China can import energy, export manufactured goods, and settle large portions of trade without touching the dollar. If China buys oil from Saudi Arabia in yuan, and Saudi Arabia recycles those yuan into purchases of Chinese vehicles, electronics, or infrastructure projects, the dollar becomes irrelevant. No need for dollar reserves. No exposure to dollar volatility. No reliance on you. So, financial institutions. But the challenge is scale. Today, about out of global trade is settled in yuan. A significant shift from a decade ago, but still tiny compared to the dollar's overwhelming dominance. At this pace, reaching parity might take 30 years, and China does not have 30 years. The dollar trap exists right now, shaping every strategic decision Beijing makes. The path out is slow, uneven, and far from guaranteed. But it is the only path available, because the alternative is mutual destruction. China has been trying to rebalance its economy away from excessive dependence on exports and toward domestic consumption. The logic is straightforward. The more Chinese citizens consume the goods produced inside China, the fewer export dollars China needs. This transformation has been a formal government objective since the early 2010s, with Beijing targeting a rise in consumption from roughly 38% of GDP to around 60% over 2 decades. To move in that direction, China poured money into infrastructure, expanded its social safety nets, raised wages, and tried to shift its economic engine from investment-heavy, export-driven growth toward services and internal demand. The transition has been slow, but real. Consumption's share of GDP has risen from the high 30% range in 2010 to the mid-50% range by the mid-2020s. But this success creates a new problem. As wages rise, China becomes less competitive on labor-intensive exports. Cheap labor was the cornerstone of China's manufacturing dominance for decades. Once wages reached a certain threshold, labor-heavy industries naturally migrated toward Vietnam, Bangladesh, Mexico, and other emerging industrial hubs. China's trade surplus, which peaked at around $400 billion annually in the mid-2010s, has slipped to roughly $250 billion a decade later. Fewer exports mean fewer dollars flowing into the system, which on the surface looks like an escape from the dollar trap. But the trap does not vanish just because inflows slow. China is still sitting on roughly $3.2 trillion in dollar-denominated assets, accumulated in previous decades. They cannot unwind that position without destabilizing both the dollar and their own financial system. So the consumption rebalancing solves the future flow problem, but not the legacy stock problem. The bulk of China's exposure is historical, and the exit corridors are narrow. To understand how slowly this escape unfolds, look at the timeline. China began pursuing diversification in the aftermath of the 2008 global financial crisis. That event was the wake-up call. Beijing realized the dollar-centric global system was fragile, and that China's massive exposure left it vulnerable to policy missteps in Washington. Almost 2 decades later, China has made measurable progress. Official gold reserves have grown from about 600 tons to more than 2,100 tons, though unofficial estimates place the real figure much higher, possibly 6,000 tons. The yuan's share of global trade has risen from essentially nothing to somewhere around mid-single digits. Treasury holdings have dropped from over $1 trillion to roughly $700+ billion. And the economic balance has begun shifting from exports toward consumption. But even with all of this, China is only a quarter of the way through the escape. At the current pace, genuine diversification, meaning dollar exposure, falling below $1 trillion, will take another 2 or 3 decades. That leads to the central dilemma. Does the dollar system last long enough for China to finish? China might need 20 to 30 years to reduce exposure to a level where dumping becomes feasible. But the dollar's internal structural problems suggest the system may hit a breaking point far sooner. Woo. Debt is rising by trillions annually. Interest costs are eating a growing share of federal spending. Inflation pressures persist. The Federal Reserve has been forced to expand the balance sheet repeatedly, and the dollar's reserve status is not eroding because China is attacking it, but because the US is debasing it from within. If the dollar collapses under the weight of its own structural issues before China completes its multi-decade escape, China will be trapped in the blast zone. They cannot dump dollars without self-destruction, but they cannot hold dollars without being destroyed if the dollar collapses. It is a lose-lose equation with no clean exits. The United States is trapped as well. Policymakers know China holds massive dollar reserves, enough to trigger global panic if sold abruptly. That reality constrains American policy options. The US cannot deploy the same financial weapons against China that it used against Russia. When Russia invaded Ukraine, Washington froze nearly $300 billion of Russian reserves with a single administrative action. But China's position is an order of magnitude larger, and freezing it would be suicidal. China would retaliate instantly by unloading whatever it could, triggering a cascade of financial destruction that would engulf both nations. This dynamic creates a form of mutually assured financial destruction. China's dollar reserves are not a weapon they can fire offensively, but they are a deterrent that prevents the United States from escalating economically or financially beyond a certain threshold. This is also why China cannot accelerate diversification. If Beijing sold even a few $100 billion in Treasuries within a year, markets would interpret it as an act of hostility. Panic would spread. Political relations would collapse. The US would respond with aggressive sanctions, cutting off technology access, financial channels, and critical imports. The economic damage to China would outweigh whatever benefit they gained from selling. So China is forced into a slow, controlled unwind, even though the clock is against them. And the United States is forced to tolerate China's slow reduction because the alternative is a mutually destructive financial war. In the meantime, This slow motion unwinding actually supports the dollar temporarily. China buys fewer treasuries each year, but it is not dumping existing holdings in any meaningful volume. Reductions of a few dozen billion at a time sound large, but are trivial relative to total holdings. This means Treasury demand declines gradually rather than collapsing overnight. Interest rates rise slowly rather than so-saping violently. Markets can adjust. The Federal Reserve can compensate. The erosion is steady, not catastrophic, but gradual decline has a tipping point. Once global reserves held in dollars fall below a certain threshold, often considered around 50% confidence can fracture. Other nations see the shift and accelerate diversification. What was gradual becomes rapid. The dollar moves from dominant reserve currency to legacy system in retreat, and the transition becomes self-reinforcing. Dollar share of global reserves has already fallen from the early 2000s peak in the 70% range to the mid-50% range today. At current trend lines, the 50% mark will be reached sometime in the next decade, and possibly sooner. That point marks a psychological shift. The question stops being, will the dollar remain the reserve currency, and becomes what replaces it. That opens the door to gold-linked systems, BRICS currency arrangements, and regional financial blocks. And here is the final irony. Both countries created this trap together. For 40 years, the U.S.-China relationship was mutually beneficial. China industrialized rapidly by exporting to the U.S., lifting hundreds of millions out of poverty. The U.S. enjoyed decades of cheap imports, lower inflation, and strong corporate profits. Both economies rose together, but dependency cuts both ways. What began as a win-win system evolved into a delicate balance of vulnerabilities, where neither side can escape without triggering systemic damage. The result is a global financial order held together by inertia, fear, and the hope that the crisis arrives later rather than sooner. For decades, the United States enjoyed the benefits of China's industrial rise. American consumers filled their homes with inexpensive goods. $20 kitchen appliances, $50 televisions, clothing cheaper than fabric itself. Purchasing power seemed to rise even as wages stagnated, because imports suppressed the cost of living. Corporations profited immensely by shifting manufacturing to China. Apple, Nike, GME, countless others built global empires on Chinese labor and American consumption. The stock market soared on margins artificially inflated by offshoring. At the same time, the U.S. government received something even more valuable than cheap goods, cheap financing. Every dollar China earned from its export boom flowed back into U.S. treasuries. This recycling kept interest rates low and allowed Washington to run deficits that would have been intolerable under normal financial conditions. Both sides won. China industrialized at breakneck speed. The U.S. is consumed beyond its means without immediate consequence. But the mechanism that produced the mutual benefit also created a mutual dependency. And over time, that dependency hardened into a trap. China's rapid industrialization required accumulating trillions of U.S. dollars. America's cheap imports required China to keep producing endlessly. The feedback loop grew so deep that neither side could unwind it without destabilizing the system that made them prosperous. And now, 4 decades later, the system is degrading. China's labor costs have risen to the point where many manufacturing operations have moved elsewhere. The competitiveness that once fueled China's surplus is no longer guaranteed. Meanwhile, the fiscal position is deteriorating rapidly. Debt is rising faster than economic growth. Interest expenses are becoming unsustainable, and the dollar is slowly losing the privilege that kept the entire arrangement functional. The benefits are evaporating, but the trap remains. Both nations want an exit, yet neither can leave without catastrophic damage. It resembles two mountain climbers, roped together on a fragile cliff face. If one slips, both plunge, so they search for footholds. China diversifying reserves, building domestic demand, and accumulating alternative assets. The Wu is trying to maintain global confidence in the dollar while financing deficits that grow larger with every political cycle. But the cliff itself is eroding, and time is not on their side. The awareness of the trap is not limited to outsiders. Within ministries, central banks, and financial institutions, the architecture of this dependency is well understood. The question is not whether policymakers recognize the danger they do. The question is whether escape is possible before the structure collapses under its own weight. Over the next decade, the world will witness the same slow-motion divergence that has been underway for years, but with rising urgency. China will continue accumulating gold, signing yuan-based trade agreements, and shifting toward internal consumption. The Wu State will continue debasing the dollar through deficit expansion, monetary intervention, and inflationary policy. Meanwhile, the dollar's share of global reserves will keep declining, first gradually, then with increasing speed as confidence erodes. The descent from the mid-50% range to the psychological threshold of 50% will likely be the turning point, and further slippage to 40% would signal a genuine regime shift. During this transition, three main outcomes are possible. The first is an orderly handoff. The dollar remains important, but no longer dominates. A multipolar currency world emerges: yuan for Asia, the euro for Europe, the dollar for the Western Hemisphere. No crisis, no collapse, just a redistribution of financial gravity. But this requires political stability, coordinated policy decisions, and an absence of global shocks. In other words, it requires a level of competence and luck rarely seen over long time horizons. The probability of this scenario is low. The second possibility is a crisis-driven transition. A debt ceiling showdown, a major bank failure, or a geopolitical conflict could trigger a sudden loss of confidence. In such a scenario, China would be forced to sell dollar assets defensively, not as an attack, but as a survival mechanism. The U.S. would retaliate financially. Markets would panic. Currencies would convulse. The result would be a global crisis. Massive wealth destruction followed by years of rebuilding. This is the most likely scenario because it aligns with historical patterns of monetary regime change. Slow boil. Sudden snap. The third scenario is the most destructive. The dollar collapses under the weight of yen, debt and inflation. Before China completes its diversification, China, still heavily exposed, suffers catastrophic losses on its dollar holdings. The Wu spirals into its own crisis as confidence evaporates. Both economies contract sharply and simultaneously, each hit differently, but severely. Neither gains an advantage. Both sink deeper into instability. Across all three possibilities, one reality is unavoidable. None of the outcomes are good. The best-case scenario is a managed decline. The worst-case scenario is mutual annihilation. And the most probable path lies somewhere between a disorderly transition and a disruptive financial confrontation. This is not about taking sides. It is not about cheering for one country over another. It is about understanding that the global financial system is built on a structure that has outlived its stability. The $3.2 trillion in Chinese dollar holdings is not a weapon China can use against America. It is a liability that chains them together. And as the U.S. continues to accumulate debt into the $40 trillion range and beyond, as China continues trying to escape the dollar's gravitational pull, the instability grows. You are watching the slow disintegration of the financial architecture that defined globalization for 40 years. And when that architecture fails, national flags will not matter. Your savings, investments, and purchasing power are denominated in currencies tied to this fragile system. The dollar will lose value. The yuan will be volatile. The transition, however, it unfolds, will destroy wealth on a scale not seen in generations. Understanding the trap matters, not because individuals can change the outcome, but because individuals can protect themselves from the worst consequences. Gold, Bitcoin, real assets, productive enterprises. These lie outside the monetary stalemate. When the two major currencies are trapped, you must hold things that are not. The $3.2 trillion trap is the most important financial dynamic of our era, and it is largely invisible because both governments have incentives to deny it. China cannot admit its vulnerability. The U.S. cannot acknowledge China's leverage, so both remain silent, executing slow strategies, hoping for time they may not have. If this shifts your understanding of the U.S. China financial relationship, if it reveals why neither nation can win this standoff, then you are beginning to see the true machinery behind global finance. Not the narratives politicians tell, not the headlines the media amplifies, the actual mechanics of the trap. In the next analysis, we will examine exactly where China is channeling the dollars it quietly removes from treasuries. Because it is not just gold. There are three other categories of assets. They are accumulating signals of where long-term value is expected to survive once the dollar trap finally breaks.